Over the next few years, more than $10 trillion in public and private debt will need to be refinanced. That number is not dramatic because it is large. It is dramatic because of timing. Much of this debt was issued when interest rates were near zero. Today, rates are structurally higher. The cost of borrowing has reset. Most people never see this wall coming. It does not appear on a breaking news banner. It lives inside bond maturity schedules, treasury auctions, corporate refinancing calendars, and municipal rollover plans. It is technical, quiet, easy to ignore. But the question is simple. What happens when debt does not disappear? It just becomes more expensive. Debt in itself is not unusual. Governments borrow. Companies borrow. Households borrow. In a healthy system, debt supports growth. You borrow today, invest productively, earn more tomorrow, and repay the loan with income that is larger than before. That is the ideal cycle. The problem begins when the cost of debt rises faster than the income used to service it. For over a decade, the global economy operated in a low-rot world. Central banks suppressed yields. Liquidity was abundant. Borrowing was encouraged. Asset prices rose. Housing expanded. Corporations refinanced again and again, often extending maturities at lower and lower costs. Debt felt manageable because interest payments were manageable. Now that environment has changed. When rates rise, old debt does not immediately adjust. It waits, it matures, and when it matures, it must be refinanced at the new rate. That is where the pressure begins. A company that once paid 2% may now pay 6 or 7%. A government that financed deficits cheaply now faces interest expenses that consume a larger share of its budget. The debt itself did not grow overnight. The price of carrying it did. This is the essence of the debt trap. As refinancing costs climb, more cash flow goes toward servicing past obligations. That leaves less for investment, hiring, innovation, and social programs. Growth slows. Slower growth makes the existing debt burden feel heavier. To offset that pressure, more borrowing is often required. The cycle tightens. From the outside, markets may still look stable. Stock indexes may hold up. Unemployment may remain moderate. But beneath the surface, the math begins to shift. When interest expense rises faster than economic output, something eventually adjusts. That adjustment does not always come as a sudden crash. In fact, it rarely does. Instead, wealth can erode slowly. Inflation reduces purchasing power. Asset valuations compress as discount rates rise. Governments facing higher interest bills may raise taxes or reduce benefits. Currency values may weaken under the weight of expanding deficits. Each step feels manageable on its own. Together, they can compound into something far more significant. A 30% reduction in real wealth does not require panic, selling, or a dramatic market collapse. It can happen through years of underperformance relative to inflation. It can happen through policy responses that prioritize stability over purchasing power. It can happen quietly, almost invisibly, until the cumulative effect becomes clear. This is why the debt wall matters. $10 trillion rolling into a higher rate world is not just a refinancing event. It is a test of resilience. It forces governments to choose between spending cuts and further borrowing. It pressures corporations to protect margins. It challenges central banks that must balance inflation against financial stability. The system becomes more sensitive. Small shocks carry larger consequences, and this tension is unfolding in a global economy that is already slowing. Demographics in developed nations are aging. Productivity growth is uneven. Supply chains are adjusting to geopolitical fragmentation. Growth is no longer effortless. When growth slows and debt costs rise at the same time, the margin for error narrows. The real risk is not that everything collapses tomorrow. The real risk is that the structure of the system changes gradually in ways that transfer wealth from savers to borrowers, from fixed incomes to flexible capital, from cash holders to asset owners with pricing power. To understand whether this adjustment becomes controlled or chaotic, we need to examine what has fundamentally changed in the rules of the game. Because for years, markets operated under one powerful assumption. When stress appeared, central banks would step in and make money cheaper. That assumption is now being tested. For years, investors operated under a simple belief: when markets tremble, central banks respond. If growth slows, rates fall. If asset prices drop sharply, liquidity expands. This pattern repeated often enough that it began to feel permanent. But permanence in finance is usually an illusion. From the aftermath of the global financial crisis through the pandemic era, interest rates in much of the developed world hovered near zero. In some regions, they fell below zero. Borrowing was not just affordable, it was encouraged. Governments financed deficits cheaply. Corporations issued long-term bonds at historically low yields. Homebuyers locked in mortgages that would have seemed impossible a generation earlier. The entire system adjusted to this environment. Asset prices rose because discount rates were low. Business models were built on inexpensive capital. Private equity thrived on leverage. Venture capital assumed liquidity would remain abundant. Even government budgets quietly incorporated the assumption that interest expense would stay contained. Then inflation returned. At first it was described as temporary. Supply chains were disrupted. Energy prices surged. Demand rebounded quickly after but as price pressures broadened, central banks faced a constraint they had not faced in years: credibility. Inflation changes the calculus. When prices rise persistently, lowering rates can worsen the problem. Expanding liquidity can weaken currencies. Policy flexibility narrows. Central banks must consider not only market stability, but also purchasing power and long-term confidence. This is where the old rule begins to fracture. In the past, financial stress often led to rate cuts. Today, financial stress can collide with inflation targets. If inflation remains above target, easing policy becomes politically and economically costly. That tension reshapes expectations. At the same time, geopolitics has grown more fragmented. Trade relationships are shifting. Supply chains are being restructured for security rather than efficiency. Energy markets are more volatile. These structural forces push costs higher and reduce the deflationary impulse that once allowed central banks to act aggressively without immediate inflation consequences. In this new landscape, refinancing is no longer painless. When bonds mature today, they must be replaced at higher yields. A government that once paid an average rate of 1 or 2% may now face 4 or 5% on new issuance. For heavily indebted nations, that difference translates into tens or even hundreds of billions in additional annual interest expense. Corporations face similar arithmetic. A company with thin margins may find that higher borrowing costs absorb profits that once funded expansion. Some firms will adapt, others will struggle. The pressure is not evenly distributed, but it is widespread. The signal to watch is not just the level of debt, it is the share of income consumed by servicing that debt. When interest expense grows faster than tax revenue for governments, deficits widen even without new spending. When interest expense rises faster than operating income for companies, credit ratings weaken and refinancing risk increases. Households with adjustable rate loans feel it directly in monthly payments. Historically, when this imbalance persists, outcomes tend to cluster around two paths. Either defaults increase, forcing restructurings and losses, or currencies weaken, allowing debt burdens to shrink in real terms through inflation. Sometimes both occur in different sectors at the same time. Markets sense this tension, even if headlines do not emphasize it. Rising bond yields are not just a number on a screen. They represent the price of time and trust. When yields climb, it signals that lenders demand greater compensation for risk. That demand reflects uncertainty about inflation, fiscal discipline, and long-term stability. Underneath steady equity indexes, bond markets may be sending a quieter message. Capital is becoming more selective. Liquidity is no longer unlimited. The cost of mistakes is increasing. This shift breaks more than one assumption. It challenges the belief that stimulus will always arrive quickly. It questions the sustainability of business models built on perpetual refinancing. And it exposes which balance sheets were structured for a low-rich world that may not return soon. Yet debt and interest rates do not operate in isolation. They interact with real production, energy flows, and global supply networks. If the cost of capital rises, at the same time the cost of producing goods increases, the pressure compounds. To understand where this pressure ultimately concentrates, we need to look beyond bond markets and into the physical foundations of the economy itself. Rising yields and tightening liquidity tell us that capital is becoming more cautious. But capital does not operate in a vacuum. It flows through factories, ports, pipelines, data centers, and power grids. To understand where financial pressure ultimately lands, we have to examine the physical economy beneath it. Debt is a claim on future production. It assumes that goods will be made, services will be delivered, and income will be generated. When that production process becomes more expensive or less efficient, the assumptions behind the debt begin to weaken. For decades, globalization acted as a powerful stabilizer. Companies optimized supply chains for cost and speed. Manufacturing shifted to lower-wage regions. Energy moved through integrated networks. Critical minerals were sourced wherever extraction was cheapest. This system reduced input costs and helped suppress inflation. It also created deep interdependence. Now the interdependence is being reconsidered. Trade tensions, sanctions, and security concerns are reshaping supply routes. Nations are prioritizing resilience over efficiency. Reshoring and friendshoring are no longer fringe ideas. They are policy objectives. But resilience has a price. Building redundant factories costs more than relying on a single low-cost hub. Diversifying energy sources requires new infrastructure. Stockpiling critical components ties up capital. Each layer of protection adds structural expense to the system. Energy sits at the center of this shift. Modern economies run on affordable and stable energy flows. When energy prices spike or become volatile, production costs ripple outward. Transportation, manufacturing, agriculture, and digital infrastructure all depend on it. Higher energy costs compress margins and reduce discretionary income. At the same time, control over key materials has become a strategic advantage. Nations that dominate rare earth elements, lithium, copper, or semiconductor fabrication hold leverage in negotiations. Commodity exporters can influence prices through production decisions. Shipping routes can be disrupted by regional instability. This is where finance and power intersect. Heavily indebted countries rely on steady growth to manage obligations. If growth slows because production costs rise, tax revenues grow more slowly. Social pressures increase. Fiscal flexibility shrinks. In contrast, countries rich in resources or energy may benefit from higher prices, strengthening their external balances. The imbalance widens. Consider the relationship between structural costs and debt sustainability. If an economy grows at 4% and pays 2% on its debt, the burden is manageable. But if growth slows to 1 or 2% while borrowing costs rise to 4 or 5%, the arithmetic turns negative. Servicing past promises consumes a larger share of current output. Higher structural production costs push growth lower. Lower growth makes high debt more fragile. This is not simply a cyclical slowdown. It is a shift in the cost base of the global system. When supply chains fragment, economies lose some of the scale advantages that once drove down prices. Inflation becomes less responsive to interest rate hikes because part of the pressure is not demand-driven, but supply-driven. Monetary policy can reduce credit expansion. It can cool housing markets. It can influence consumer behavior. But it cannot easily increase oil production, accelerate mining permits, or rebuild global logistics networks overnight. That limitation matters. If central banks tighten too aggressively in a supply-constrained world, they risk suppressing growth without fully resolving inflation. If they ease prematurely, they risk reigniting price pressures. The margin for precision narrows. Meanwhile, corporations facing both higher input costs and higher borrowing costs must choose where to absorb the impact. Some pass it to consumers through higher prices. Others cut investment or reduce staff. Over time, these adjustments influence wages, employment, and consumer confidence. The debt trap becomes reinforced by physical realities. Expensive capital meets expensive production. Growth slows from both directions. And as these structural pressures build, governments may find that traditional tools are insufficient. If monetary policy cannot fully offset supply fragmentation, attention inevitably shifts toward fiscal measures, currency management, and broader monetary frameworks. Because when production power shifts and debt burdens grow heavier, the next battlefield is not only about goods and energy, it is about money itself. When production power shifts and structural costs rise, pressure does not remain contained in factories or shipping lanes. It moves into the monetary system. Because debt is not only a contract between borrower and lender, it is also a promise denominated in currency, and currencies are policy tools. Governments facing higher interest expenses eventually confront a narrow set of choices. They can cut spending, which risks slowing growth and increasing political friction. They can raise taxes, which may reduce private investment and consumer demand. They can tolerate defaults, which damage financial stability and confidence. Or they can attempt to reduce the real value of debt through inflation and currency depreciation. Historically, outright austerity is difficult to sustain. Democracies resist deep cuts. Credit events are disruptive and unpredictable. That leaves a more subtle path, managing the burden over time through controlled erosion. Inflation, when moderate but persistent, reduces the real value of fixed liabilities. If wages and nominal GDP rise while the face value of debt remains constant, the debt-to-GDP ratio can stabilize or decline. From a policymaker's perspective, this can appear less painful than sudden fiscal contraction. But inflation is not neutral. It redistributes. Savers holding cash or fixed-income assets lose purchasing power if interest rates fail to fully compensate for rising prices. Bondholders experience price declines when yields adjust upward. Retirees on fixed incomes feel the squeeze first. Meanwhile, borrowers benefit if they repay obligations with currency that is worth less than when they borrowed it. Currency depreciation operates similarly. A weaker currency can boost exports and reduce the real burden of domestic debt. Yet it also raises the cost of imported goods and commodities, feeding domestic inflation. In a globally interconnected system, currency shifts transmit quickly through trade balances and capital flows. This is where the hidden consequences begin to surface. Equity markets may continue to rise in nominal terms. Corporate revenues can increase simply because prices are higher. Investors may feel wealthier when account balances grow. But if inflation outpaces those gains, real purchasing power declines. The illusion of progress masks a quieter erosion. Bond markets respond more directly. As investors demand higher yields to offset inflation risk, bond prices fall. Portfolios that once relied on fixed income for stability may experience unexpected volatility. Duration becomes a risk factor rather than a safe harbor. Real assets behave differently. Commodities, real estate, and infrastructure may benefit from pricing power during inflationary phases. But even these assets are sensitive to interest rates. Higher borrowing costs can suppress property values or reduce speculative demand. The interaction between inflation, taxation, and valuation compression creates a layered effect. Governments facing higher interest bills may increase taxes to stabilize budgets. Higher tax burdens reduce after-tax returns. At the same time, elevated discount rates lower the present value of future earnings, compressing equity multiples. None of these forces require a dramatic market crash. Imagine a period where inflation averages 4%, but investment portfolios return 5% before taxes. After adjusting for inflation and taxation, real gains may be negligible. Over several years, that gap compounds. A 30% erosion in real wealth can occur gradually, without a single catastrophic headline. This is the nature of policy-driven adjustment. It unfolds over time. It feels manageable in the moment. Each year's change seems modest, but the cumulative effect reshapes balance sheets and expectations. The key insight is that debt sustainability is not resolved only through growth or default. It is often managed through the currency channel. When interest costs strain fiscal capacity, monetary frameworks adapt, sometimes subtly, for individuals and institutions. This means the risk environment changes, even if daily life appears stable. The value of savings, the reliability of fixed income, and the purchasing power of wages all depend on how policymakers navigate the trade-offs between inflation control, and financial stability. Understanding this dynamic requires more than watching headlines. It requires a framework for interpreting how money, policy, and production interact over time. And that brings the focus closer to home. Because these macro adjustments do not remain abstract. They filter into mortgages, retirement plans, job markets, and everyday decisions in ways that are often misunderstood. These macro adjustments may seem distant, but they surface in ordinary places. They show up in mortgage statements, grocery bills, job contracts, and retirement accounts. The transmission from policy to personal finance is rarely immediate. It moves gradually, often with a delay. Yet once it arrives, it shapes everyday decisions. Consider mortgage rates. When bond yields rise, borrowing costs for homes follow. A family that qualified for a loan 2 years ago at 3% may now face rates closer to 7%. The difference is not abstract. It changes monthly payments, affordability, and housing demand. Slower housing markets then affect construction jobs, materials, suppliers, and local tax revenues. Retirement portfolios reflect similar pressures. Many long-term investors rely on a mix of equities and bonds. In a low-rate world, bonds provided both income and stability. But when yields rise rapidly, bond prices fall. At the same time, equity valuations may compress as higher discount rates reduce the present value of future earnings. Portfolios designed for one environment must adapt to another. Job security is also tied to financing conditions. Companies facing higher borrowing costs and slower demand often reduce expansion plans. Hiring slows, wage growth moderates. In some sectors, layoffs follow. These adjustments rarely happen all at once. They occur in phases, often starting with the most interest-sensitive industries. Small businesses feel the shift acutely. Unlike large corporations, they may lack access to deep capital markets. They depend on bank credit lines or variable rate loans. When financing becomes more expensive or harder to obtain, investment pauses. Expansion is delayed. Risk tolerance declines. To interpret these changes clearly, it helps to rely on mental models rather than headlines. The first model is the refinancing clock. Debt does not disappear. It matures. Whether it is a government bond, a corporate loan, or a household mortgage, it eventually must be rolled over. When rates are higher, at the moment of refinancing, cash flow adjusts. Watching maturity schedules provides more insight than watching daily market swings. The second model is the interest burden ratio. This measures how much income is consumed by servicing debt. For households, it may be the share of monthly earnings spent on loans. For governments, it is the percentage of tax revenue allocated to interest payments. When this ratio rises persistently, flexibility declines. Spending choices narrow. Vulnerability increases. The third model distinguishes nominal versus real returns. A portfolio that grows 6% during a period of 5% inflation is barely advancing in real terms. After taxes, it may be losing ground. Understanding this difference prevents the illusion of progress when purchasing power is stagnant or falling. The fourth model is policy lag. Monetary and fiscal changes take time to filter through the system. Rate hikes implemented today may influence employment or investment 12 to 18 months later. Similarly, stimulus measures may boost activity with delay. Recognizing these lags reduces the temptation to overreact to short-term data. Together, these frameworks encourage structural thinking. Instead of asking whether markets will rise or fall next month, the more durable question becomes, how are debt costs, growth rates, and policy responses interacting over time? Clarity does not eliminate uncertainty. It reduces emotional volatility. It allows individuals to interpret shifts in housing, labor markets, and asset prices within a broader context. The goal is not prediction. It is orientation, because the future will not unfold along a single path. Multiple outcomes remain possible, shaped by policy decisions, geopolitical developments, and economic resilience. To move forward responsibly, we must examine those potential paths and consider how the debt cycle could resolve from here. To move forward responsibly, we have to accept a simple constraint. No debt cycle ends in stasis. It resolves. The only question is how. There are three broad paths from here. None are guaranteed. Each depends on political choices, global coordination, and the stability of supply chains and energy flows. The future is path-dependent, shaped by decisions made under pressure. The first scenario is gradual adjustment. In this path, inflation remains moderately above target, but does not spiral. Growth slows, yet avoids deep contraction. Interest rates remain elevated relative to the past decade, but stabilized. Governments manage deficits without dramatic austerity, relying on steady nominal GDP growth to contain debt ratios. In this environment, wealth erosion occurs quietly. Real returns are modest. Asset prices fluctuate but do not collapse. Over time, purchasing power drifts lower relative to past expectations. Savers feel restrained, but the system avoids acute crisis. This is the slow burn resolution. Controlled dilution, spread across years. The second scenario is policy pivot. Here, economic weakness intensifies. Unemployment rises meaningfully. Financial markets strain under refinancing pressure. Policymakers respond decisively, cutting rates and reintroducing liquidity measures. Fiscal spending expands to offset private sector contraction. Growth stabilizes, but at a cost. Currencies may weaken as deficits widen. Asset prices, particularly equities and real assets, may rise sharply in nominal terms as liquidity returns. Inflation risks re-emerge, especially if supply constraints persist. In this scenario, the debt burden is managed through renewed stimulus. The immediate stress recedes, yet long-term currency purchasing power becomes the adjustment valve. The system survives, but money itself absorbs the strain. The third scenario is stress event. In this path, refinancing pressures intersect with a catalyst, a large corporate default, a sovereign funding scare, a sudden liquidity freeze in a critical market. Confidence shifts rapidly. Credit spreads widen. Asset prices reprice quickly. Policymakers intervene, but the reaction comes after volatility has already reset valuations. Some debts are restructured. Certain institutions consolidate or disappear. The adjustment is sharper, more visible, and more disruptive. History shows that debt cycles often combine elements of all three. A period of gradual erosion may be interrupted by sudden stress. Policy pivots can delay, but not eliminate, structural constraints. Outcomes rarely follow a clean script. What remains constant is the mechanism of resolution. Debt burdens shrink through one of three channels: stronger growth than expected, explicit restructuring, or currency dilution. Growth requires productivity gains and stable supply systems. Restructuring requires political tolerance for losses. Dilution requires acceptance of lower purchasing power. Denial is not an option. Ignoring refinancing clocks or interest burden ratios does not stop them from advancing. For viewers and investors, the objective is not to predict which scenario will dominate next quarter. It is to recognize which signals indicate a shift from one path to another. Rising credit spreads, accelerating inflation, unexpected policy changes, or geopolitical shocks all alter probabilities. And beneath all three scenarios lies a deeper question. If debt pressures currencies, and currencies are the foundation of savings, what assets stand outside that direct liability structure? How do gold, commodities, and alternative reserve systems behave when trust in fiscal and monetary stability begins to adjust? These are not speculative curiosities. They are historical patterns that reappear whenever monetary regimes are tested. In the next chapter of this investigation, we step back from debt metrics and examine the long arc of monetary resets, how they unfold, who adapts first, and why tangible assets often re-enter the conversation when confidence shifts, not as a reaction to panic, but as a response to arithmetic.